Good morning, everyone. Thank you for joining us for this session on solvent exit planning for insurers. My name is Sarah Awabia. I'm a partner in our risk consulting team here at Forvis Mazars, and I specialise in regulatory compliance. Before we dive into the session, a quick rundown on the format for this webinar. We're aiming for an engaging session, so please use the Q&A box for your questions. And for those on LinkedIn Live, please drop your questions in the comment box and we'll try to address them in our Q&A at the end. This session is being recorded and it will be available on our website and via email afterwards. So feel free to share it with your colleagues. Today, I'm pleased to be joined by our panel of experts. We have four experts: Humera Muzamel, who's an Associate Director in our Regulatory Compliance team, Ludmila Salama, who's also an Assistant Manager in our Regulatory Compliance team, and then Jatin Sharma, a Manager from our Actuarial team, and McDonald Ugwazoha, who's a Manager in our Banking Risk Consulting team. So let's move on to the agenda. As hopefully you're all aware, solvent exit planning is a new requirement, and today we're going to cover what the implications are for insurers. We'll also cover the components of a credible solvent exit plan and how to leverage on existing frameworks. We'll also discuss the role of stress testing, financial resilience, and the operational implications that need to be considered in executing a solvent exit. And then finally, we'll hear some insights from our banking team to understand the lessons that we can learn from the banking sector's implementation of the solvent exit rules. So before we begin, if we just go to the next slide, it will be great to understand where you currently stand in terms of your readiness for these new rules and your journey to compliance with the solvent exit planning rules. So we've set up a Slido question for this. So please scan the QR code on the screen and select the answer that best describes your situation. We'll take about a minute for everyone to respond. Wonderful. So let's see what we've got here. I guess it's changing all the time. So most of you, it seems, just under half have just started working on the plan, which is great. There is less than a year to implementation now, so obviously that's going to be really important to make sure that that project gets underway. And some of you, about a third, are looking to find out a bit more about what's required. So hopefully we can help you with that today. So thank you for your responses anyway. So now it's my pleasure to hand over to our first expert, who is Humera, who's going to provide an overview of what the solvent exit planning means for insurers and what the PRA expects. So over to you, Humera.
Good morning, everyone, and thank you for joining us for this session today. Today, I'll be walking you through the PRA's expectations around solvent exit planning, what it means, who it applies to, and what firms need to do to prepare. This is a topic that's becoming increasingly important as the PRA continues to focus on making sure that firms can exit the market in an orderly and controlled way. That's without having to rely on insolvency or resolution processes as a backstop. Over the past few years, we've seen a growing emphasis on resilience, not just in how firms operate day to day, but also in how they plan for the unexpected. And part of that resilience is being able to wind down operations in a way that minimizes disruption and to the policyholders, the market, and the wider financial system. So in order to support this, the PRA introduced new rules and expectations for insurers, which were confirmed in a supervisory statement published in December 2024. These rules will come into effect on 30 June 2026, so that's pretty much a year from today. Now, if this all sounds a bit familiar, that's because similar expectations have already been rolled out for the banking sector. Their rules come into force a little earlier, October this year, so insurers do have a bit more time to get ready. These rules apply to all PRA-regulated insurers, except for those in passive runoff, UK branches of overseas insurers, and Lloyd's managing agents. So if you're in scope, these expectations apply to you. And importantly, this isn't something that should be sitting on the shelf until there's a problem. The PRA expects firms to prepare for a solvent exit as part of their business as usual activities. This means building it into your regular planning and governance processes and not just treating it as a crisis response. So that means putting together a solvent exit analysis, also referred to as an SCA. This document should be updated whenever there's a material change or at least every 3 years. While you're not expected to submit it to the PRA right away, supervisors may request it after the rules go live. So the key takeaway here is you should be ready to provide the SCA to the PRA if asked. Now, in addition to the SCA, there's another layer of expectations, but only if a solvent exit becomes a reasonable prospect. In that case, firms will need to prepare a solvent exit execution plan, or also known as a SEEP, and manage the exit in line with that plan. So to put it simply, because I know regulation and simplicity doesn't always go hand in hand, by 30 June next year, firms in scope need to have their SCA ready. The SEEP only comes into play later if and when a solvent exit becomes a real possibility, either triggered internally or by the PRA. So now let's take a closer look at what your SCA should actually cover. There are a few key sections to think about, and we can begin with solvent exit actions. Here you need to outline the main options your firm would consider for a solvent exit. So this could include a runoff, a partial sale of the business, or a merger with another insurer or mutual. The idea here is to show that you've thought through the different paths available and have a realistic sense of what might work best for your firm. Next, solvent exit indicators. These are early warning signs that might suggest a solvent exit is becoming more likely. You want a mix of both quantitative and qualitative indicators. So quantitative indicators may be things like your solvency ratios, underwriting losses, or liquidity matrix. Qualitative indicators could include operational difficulties, governance issues, or high staff turnover. You don't really need to create a new set of indicators from scratch. You can adapt existing ones from, for example, your ORSA, either your capital management plans or recovery and resolution planning. The projected and actual levels, as well as the trends and the appropriateness of these indicators, should be monitored on an ongoing basis. For barriers and risks, here you need to consider what could get in the way of a successful solvent exit. So this should identify both market-wide risks and firm-specific risks. You should assess how these risks could impact your exit strategy and take reasonable steps to mitigate or remove any material barriers as part of your business as usual activities. Again, you can draw an existing analysis from your ORSA or other planning documents. This brings us next to resources. This includes both financial and non-financial resources. So financial resources include capital, reinsurance, funding, liquidity, and any other additional costs or potential losses, for example, from asset sales, a haircut. Non-financial resources will be, for example, access to external advisors, legal support, or key staff who will be critical in executing your exit. And then another key area is communication. Who are the key stakeholders that will be affected by a solvent exit? So of course, this will include your policyholders, the regulators, your employees, and business partners. Your SCA should outline how you plan to communicate with these groups, both before and during the exit, and then how you would actually manage any potential negative impacts that could arise. Again, for this section, you can leverage on the internal communications plans that you may already have developed that exist already under your framework, such as the ORSA. Another area of focus is governance and decision-making. Firms need to have clear governance arrangements in place, including a senior manager. So that's somebody that's approved under the senior manager's regime. This person will be accountable for overseeing business as usual preparations and approving the SCA. Further down the line, this person would also decide whether a SEEP is needed. That's the solvent exit execution plan, and then to monitor the execution of an exit if it happens. Hopefully by now, most firms have already identified who that person is or are in the process of doing so. And finally, assurance. Your SCA should go through appropriate assurance. That can either be internal or external. That's entirely up to you. The senior manager should confirm that the SCA meets the expectations that have been set out in the supervisory statement and that are approved within your governance processes. You have some flexibility in how you document your SEA. You can include it as a section within your ORSA, your capital management plan, or your recovery and resolution plan, if you have one, or keep it as a standalone document. Either approach is fine as long as the content is clear, complete, and accessible when needed. The PRA have also signposted existing frameworks, which can be really helpful as you start putting your SCA together, or even if you've already put it together or in good progress, having a look at what else you could leverage on. These examples highlight what a well thought out, practical solvent exit plan should consider. And with that, I'll hand over to Ludmila, who'll take us through these examples in more detail and share some insights on what firms can leverage on.
Thanks, Hamera. Yes, so the PRA highlighted two FCA publications that may be useful for firms, the Wind Down Planning Guide and Thematic Review on Wind Down Planning, and both offer practical insights and examples of good practice that firms can leverage from and learn from in their solvent exit planning preparations. So just as a bit of background, the Wind Down Planning Guidance is aimed at solo regulated firms like insurance intermediaries, and the objective is to help reduce risks to consumers and the broader market when a firm winds down its operations. And much like solvent exit planning, it's about identifying the steps and resources needed to wind down in an orderly way, whilst also thinking about how to manage and mitigate the risks involved. And whilst insurers will have different capital structures and regulatory frameworks, there is still a lot of relevant takeaways, especially around governance, risk identification, and planning for plausible but severe scenarios. So let's walk through some of the key points from the FCA's guidance and how they relate to solvent exit planning. So firstly, risk management. So solvent exit planning shouldn't sit in a silo. It needs to be part of your broader strategic and risk management frameworks. And that means integrating it with capital planning, group strategy, and your firm's risk appetite. And it's also important that this planning is scenario-based. So don't just rely on historical data. Think about the specific risks tied to your business model. And these insights should then feed into your stress testing so you can understand what might actually trigger a solvent exit. And this isn't a one and done exercise, so firms should then regularly revisit and update their risk assessments, management actions, and mitigants because these can evolve over time. So then if we move on to look at governance, as Hamera mentioned earlier, insurers need to make sure there's appropriate governance and board oversight of solvent exit planning. And this should be put in place early so the right people are ready to oversee the process. And it's not just about the board reviewing the risks, they should be actively engaging with them. And there should also be alignment between what's on the risk register, what's being stress tested, and what's being discussed at board level. And then another point to mention is that testing the outcomes of solvent exit planning is the best way to demonstrate to both your board and the regulator that the plan is credible and workable. So next is operational planning and thinking about how the firm will exit the market in a solvent manner. And developing your solvent exit plan early will give you the flexibility to adjust your business model and explore more efficient exit strategies. And then any additional time can be used to refine and evolve the plan. And then lastly, financial resources. So a credible plan needs to be backed by the right resources, and that means identifying realistic costs, timelines, and resource needs. And this should also include consideration of additional costs for the solvent exit, possible losses, as well as the cost of resources needed to mitigate any barriers or risks. So if we now move on to look at the FCA's thematic review on wind down planning, this highlighted three key focus areas: liquidity, triggers, and group interdependencies. And these will also be important considerations for solvent exit planning. So the first is liquidity, and we will discuss this in more detail in the next section. But as a brief overview, firms often focus on capital but overlook liquidity. And during a solvent exit, you still need to meet your liabilities as they fall due. And if you can't, you risk a disorderly exit or insolvency. So it's important to assess whether you can maintain liquidity throughout the process and think about how the firm's cash position may change during the solvent exit and planning for that. And the next point is triggers. So knowing when to start the solvent exit process is critical. and triggers should be clearly defined and based on realistic metrics or events. And they should be designed so that the firm starts the solvent exit process at a point where it will still have sufficient financial and operational resources to complete a solvent exit. And as we will discuss in the next section, reverse stress testing can help to identify these points. And then once you've set them, they then need to be closely monitored and embedded in your risk framework. And then finally, group interdependencies. So many insurers are part of larger groups, and if your firm relies on another group entity for funding or operational support, you need to understand and assess how those relationships might unwind under stress. So I'm now going to hand over to Jatin to discuss some of these points in more detail and give an overview of the key components of solvent exit planning from an actuarial perspective.
Thank you so much, Rutmila. I'll be covering three critical components of solvent exit planning under the PRA supervisory statement, namely the stress testing, financial resilience, and operational execution. Together, these elements form the foundation of a credible and effective exit strategy, one that protects policyholders, maintains regulatory compliance, and supports market stability. The PRA's expectations are quite clear. Solvent exit planning must be embedded into business as usual activities and treated as a dynamic, forward-looking process. So I'll begin with stress testing. The PRA clearly outlines distinct expectations for stress testing within the two core planning documents: the solvent exit analysis, which is the SEA, and the solvent exit execution plan, the SEEP. In the SEA, stress testing serves a strategic and exploratory function. It is designed to assess the feasibility of a solvent exit under plausible but adverse conditions. Firms are expected to consider scenarios, let's say, such as moderate increases in lapse rates, expense deterioration, or operational constraints. These tests would potentially help identify barriers, be it legal, financial, or operational, that could potentially complicate an exit. The purpose here is not to simulate a crisis, but to ensure that the firm understands the conditions under which a solvent exit could be realistically pursued. Now, in contrast, stress testing within the SEEP is far more detailed and execution-oriented. This plan is developed, as pointed out earlier, when a solvent exit becomes a reasonable prospect or is requested by the PRA. Stress testing here must simulate adverse conditions that could occur during the actual exit process, such as sharp declines in asset values, spikes in claims, counterparty defaults, or disruptions to third-party services. The objective here is to validate whether the exit plan remains viable under stress and whether the firm can continue to meet its obligations without breaching solvency thresholds. The PRA also encourages reverse stress testing, as highlighted by Ludmila. This would help identify scenarios that could potentially lead to the need for a solvent exit. This approach will help firms understand their vulnerabilities and prepare accordingly. I will now turn to financial resilience. This is really the capability that enables the firm to execute its exit plan while maintaining solvency and operational integrity. Now, the PRA expects firms to maintain adequate capital and liquidity buffers throughout the entire exit timeline and not just at the point of decision. So this would include covering runoff of liabilities, managing operational costs, and absorbing potential shocks. Importantly, financial resilience is to be looked at not in a static way. It must be continuously monitored and reassessed in response to changing market conditions, claims development, and emerging risks. The PRA reinforces this by highlighting the importance of dynamic stress testing and liquidity analysis to assess solvency under evolving scenarios. Additionally, as has been pointed out, that firms are expected to integrate financial resilience into their broader risk management framework, including the ORSA, capital planning, and strategic decision-making. This basically means that resilience must be forward-looking, scenario-based, and responsive to both internal and external developments. For example, firms should consider how changes in interest rates, inflation, or let's say geopolitical risks could affect their ability to meet obligations during an exit. Additionally, the PRA also encourages firms to assess the interaction between financial and operational risk, such as how a cyber event or a third-party failure could impact liquidity or capital adequacy. In short, financial resilience is not just about having buffers, it's about having the governance, the insight, and the agility to deploy them effectively. I will now turn to the last bit, which is around operational considerations, and these are equally vital to the successful execution of a solvent exit. The PRA outlines several expectations that firms must address to ensure that the process is orderly, compliant, and resilient to disruption. Now, these expectations are not really theoretical, but grounded in real-world risks and operational dependencies that can really undermine even the most well-capitalized exit plans. So firstly, firms must manage liability runoff effectively. This really includes ensuring that all policyholder obligations, particularly long-tail liabilities such as annuities or liability claims, can be met as they fall due. For example, a firm with exposure to asbestos-related claims must ensure that its claims handling infrastructure remains intact for decades. Adequate technical provisions must be maintained and tested under a range of stress scenarios, including adverse claims development or legal challenges to reserving assumptions. Second, liquidity management is very critical, something that Ludmila did touch upon earlier. I'll try to add here. Now, firms must assess whether their asset portfolios can generate sufficient cash flow to support the runoff of liabilities. This involves evaluating the liquidity profile of assets, the feasibility of asset sales under stressed market conditions, and the potential impact of market volatility or counterparty default. For instance, a firm which is heavily invested in commercial property may find it really difficult to liquidate assets quickly at the time of a downturn. So in such cases, pre-arranged credit facilities or a diversified liquidity buffer may be necessary to avoid forced sales. Third, operational continuity must be preserved throughout the exit. Now, essential services such as claims handling, policy administration, and regulatory reporting must continue without disruption. Firms should identify dependencies on third-party service providers. These could be IT vendors or outsourced claims handlers, and really assess the risk of service degradation or termination. Now, for example, if a key administrator exits the market or is acquired, the firm must have contingency plans in place, including data migration protocols and alternative providers. Similarly, key person risk must be addressed. This is, really in smaller firms where institutional knowledge may reside with a handful of individuals. Fourth, robust governance structures are essential. Now, the exit plan should clearly define roles and responsibilities, escalation procedures, and oversight mechanisms. It should also specify the triggers for execution, as pointed out earlier, and as well the process for monitoring progress and responding to emerging risks. For example, a firm might establish a dedicated exit steering committee, right, which will have the authority to escalate issues with the board if solvency metrics deteriorate or operational risk materialize. Now, the PRA really expects these governance arrangements to be embedded in business as usual operations and not just activated in crisis periods. Fifth, firms must ensure they can meet all regulatory and contractual obligations during the exit. This includes fulfilling reinsurance agreements, maintaining ongoing reporting, and communicating effectively with policyholders, regulators, and other stakeholders. Now, these obligations should be mapped and incorporated into the exit timeline with absolutely clear ownership and delivery milestones. For example, a firm with cross-border operations must ensure that local regulatory filings continue uninterrupted, even if central functions are being wound down. Finally, as pointed out earlier, solvent exit planning must be integrated into the firm's broader risk management framework. The PRA emphasizes that solvent exit planning is not a static compliance exercise. It is a dynamic, forward-looking strategy that must evolve with the business and the market. This includes considering emerging risks such as cyber, climate-related liabilities, and geopolitical instability, all of which could affect the feasibility or timing of an exit. Firms that will treat exit planning as a living part of their governance and risk culture rather than a one-off document would be far better positioned to protect policyholders and maintain market confidence. In conclusion, stress testing, financial resilience, and operational readiness are interdependent components of a well-governed exit strategy. When embedded into the firm's wider governance and risk framework and supported by technical insight and operational planning, they will enable insurers to exit the market in a solvent, orderly, and responsible manner. I'll now hand over to Donald, who will take us through the key lessons that we are seeing from the implementation of solvent exit planning in the banking sector.
Thank you, Jatin. Hello, everyone. So as mentioned earlier, the requirements for solvent exit planning for banks and non-systemic banks actually and building societies in the UK become effective on the 1st of October 2025. From our conversations with clients and our review of clients' documents, we typically see them struggle across strategic and more operational areas. From a strategic perspective, institutions typically would struggle or find it difficult to assign responsibilities for solvent exit planning, particularly where these responsibilities sort of overlap with those in the recovery and the resolution plans. Identifying and really estimating cost and resource requirements we found is another area for concern for these institutions, particularly because, like you're aware, the regulator really wants you to do a good job when it comes to identifying and really costing what it would take to effectively execute your solvent exit plan. Another area where institutions have struggled is around defining the solvent exit indicators, like Humera had previously mentioned, figuring out what your early warning indicators would look like and really determining what your invocation trigger points will be. Firms also then struggle with really modeling or determining what the solvent exit scenarios will be. And all of this, to be honest, isn't unexpected due to number one, the recency of the requirements, and also because no thematic reviews have been conducted at this point. However, what we see and what we typically will say to firms based on the regulation is there's really no need for you to, at this point, reinvent the wheel. The regulation makes provision for you to leverage your existing documents, particularly around governance, around how you look at and identify EWIs, your early warning indicators, and your trigger points, and how you look at and consider your stress testing. From an operational perspective, institutions that we've worked with or we've seen typically struggle with assigning and coordinating internal departments that are necessary for solvent exit, both to sort of produce the solvent exit analysis and to execute the plan when it becomes necessary, and ensuring that everyone really understands their roles and how to approach the process. We've also found that smaller institutions will typically struggle with identifying the communication framework and figuring out who, what, when, how, and the messaging that goes across to the respective stakeholders, both internal and external, to ensure that risk is mitigated during the solvent exit process. Another part that institutions, and this might be more prevalent for banks, is the fact that there's a lot of conflicting regulation that sort of that are almost effective at around the same point. And so institutions are struggling to sort of plan and prioritize what regulations to tackle. Another aspect is around data, and this is very important because, again, the data requirements or the data needs for institutions vary. And the fact that data is also important for you to then effectively forecast your financial resources, the costs, both exceptional and ordinary, and the potential revenue that you can get during solvent exit is quite concerning for firms, particularly those who have struggled with data and data needs in the past. And finally, figuring out what the roadmap looks like and how you can then approach solvent exit planning is something that we've seen institutions also struggle with. But to bring you home, what does that mean for you as insurance practitioners? I guess the first part is really starting early, yeah, and encouragingly, a large number of people who responded to the slide who sort of said that they had started the process or in the process of starting the solvent exit analysis. But more importantly, it is for you to adopt a very fluid approach that ensures that you can, one, identify and mitigate risk, and two, where any residuals continue to exist, you can therefore plan for it accurately. The process might be as simple as really just reviewing your capabilities to forecast and monitor resource or your process during solvent exit. And also, we've asked firms to sort of start looking at the existing risk appetites, the existing EWIs, and the existing invocation trigger points in the recovery plans, and figure out where exactly they would fall during the solvent exit. Another part that's very important and something that we've also said to firms and we see firms really struggle with is around updating customer information, because again, this is really important for managing communication down the line and really exiting the markets. And finally, and I mean, this might not necessarily be so important, again, is really working with your legal departments to figure out your existing contracts, really untangle the more complex ones, and then determine where you need break clauses to ensure that even during solvent exit, you're not overly encumbered by these liabilities down the line. Oh, one other part is determining if you need external support during the process and really baking that into your costs and resource requirements for solvent exit. I guess that's it from the banking side. So I'll hand over to Sarah, who would run through the final parts of the presentation and any questions we have.
Thank you, McDonald. So that concludes our presentation on solvent exit planning today, and the key points for consideration as you navigate towards the implementation date, which, as you know, is just under a year away. Hopefully you found this session today useful and informative. I can see that we already have a few questions in our Q&A box. Please do continue to post your questions, and we'll try to get through as many as we can in the time that we have left. Any unanswered questions, we'll add them to an FAQ document, which will be shared with you after the webinar, together with the recording. So with the first question that we've got here, and I think this is one for you, Millie. How detailed of a plan do you think the PRA are expecting in the case of a non-directive firm?
Thanks, Sarah. So the PRA makes it clear that every firm in scope should have a solvent exit plan, but this can be proportionate to its size, complexity, and risk profile. So that means there's no one-size-fits-all approach. So for a non-directive firm, so that's a firm outside the scope of Solvency II, the core expectations that we've discussed today will still apply, but they're scaled to fit your business. So a less detailed plan may be proportionate for a small, less complex firm, for example. But that said, even if your plan is less detailed, it still needs to reflect your specific business model, be realistic, and show that you've really thought through the risks involved in a solvent exit. And your analysis still needs to clearly outline your exit strategy, including triggers that might lead to a solvent exit, the exit strategy itself, and the operational steps needed to exit in an orderly way. So the key is that it's firm specific and practical and shows an understanding of the risks and responsibilities involved for a solvent exit. And ultimately, the PRA wants to see how the firm has taken the time to think about how it would protect policyholders and maintain control in the event of a solvent exit.
Thank you, Millie. Yeah, so I think proportionality, as we know, is always more difficult to apply in practice, but I think there's some good advice there. Thank you, Millie. So the next question is around who is leading on the implementation from within firms. And perhaps this is one for you, Jatin and Humera. Is it the CFO, the CRO, or is it someone else? And then kind of related to that, what's the general approach? Is the document being included or attached to the ORSA? Or is it kind of a standalone part or part of the recovery and resolution planning? So Jatin, maybe if I could ask you to give your views first.
Thanks, Sarah. I think we're expecting and already are seeing in a few places the CRO taking the lead on solvent exit planning, which kind of makes sense given the broad oversight of risk. As for documentation, we're definitely expecting that the solvent exit execution plan, the SEEP, will be developed as a standalone document, given the level of detail and operational specifics that it will require. The solvent exit analysis, however, is definitely expected to be referenced within the ORSA to align with capital and risk planning. Now, whether the SEA ends up as a separate document or fully embedded will likely depend on a few factors, which I think is something that Humera is better placed to advise on. So perhaps, Humera, if you can take that one on.
Sure. So the PRA have given firms the option to either insert the SCA within the existing framework, such as the ORSA, or even have it as a standalone document. So it really depends on the complexity of the firm and what the SCA will look like in the end. So for some firms, from the ORSAs we've seen, they can be quite detailed and quite long. So you might not actually want to make that even more extended. So if your SCA is extensive in its own right, depending on the complexity of your business, we might see that firms opt to have that as a separate document. However, embedding it within your existing frameworks allows you to review and monitor under your existing governance procedures adapted for solvent exit planning. So you know, it really will depend on the complexity of the SEA. For the simpler firms, we would expect that they may leverage on the existing plans and have it as a subsection. I think, as Aja spoke about earlier, McDonald did refer to, you know, what banks have struggled with. So it'd be good to just kind of get some insight in what you've seen with banks, McDonald.
Yeah, absolutely. So like you rightly mentioned, institutions sort of determine how they go about the solvent exit analysis, and typically it's based on the nature and then the complexity of the institutions. What we've seen is institutions sort of have the solvent exit analysis as a part of the recovery plan, and they make references to a lot of the analysis that they've done in the past. For more complex institutions, they have the solvent exit analysis as a separate document. And so it means more analysis and then more details into how typically they would exit the market. But what we've said to institutions is that going forward, try to align the governance and then the review cycle for your solvent exit analysis with all of your other internal documents to ensure that there's that consistency for both governance, for stress testing, for early warning indicators, and for monitoring the process.
Thank you. Thank you also. Some good guidance there, I think. So this one, I think, is for you, Jatin, as our actuarial representative. What do you think will be the key areas that actuaries are expected to contribute most to in the solvent exit planning?
Thanks, Sarah. I think it's a good one. I believe that actuaries are likely to play quite an integral role in solvent exit planning, especially in areas that would require technical insight and long-term forecasting. One of the biggest contributions will definitely be around stress testing and scenario analysis. I think actuaries are well positioned to model these scenarios. Another major area is probably the liability runoff and reserving. Because solvent exit planning involves ensuring that all policyholder obligations can be met over time, I think actuaries will play a crucial role in validating that technical provisions are adequate and resilient under stress. And this will be particularly important for long-term liabilities where, you know, claims may emerge years down the line. Another aspect that I think they might be heavily involved in is capital and liquidity assessments. You know, helping determine whether the firm can maintain solvency throughout the exit timeline. And because the PRA expects solvent exit planning to be integrated into the ORSA, I think actually will also have a lead role, you know, to support that integration. So I think to sum it all up, I think actuaries won't just be supporting the process; they'll be actively shaping it alongside other stakeholders. So really, yeah.
Thank you, Jatin. So the next question we have is about assurance. So the question is, who is best placed to provide assurance over the solvent exit planning documents? Are you seeing more external parties being involved, or is it the responsibility of the third or the second line of defence? So perhaps I'll ask that one to Humera first, if that's okay.
Yeah, sure. So The PRA hasn't mandated a specific assurance process and has given the option for both internal and external assurance processes. Internally, we may see firms rely on the internal audit function, but similarly, even external consultants or actuaries to validate key assumptions such as run-off costs or benchmark to industry norms, and also helping to stress test the wind down strategies. Ultimately, the board needs to ensure that the solvent exit plans are subject to appropriate challenge. And so I think it'll be a mixture of firms. It really depends in terms of how complex your solvent exit analysis is, and the key assurance that even the senior management function holder that will be approving and confirming that the process has been as per the supervisory statement, what gives them the comfort as well to make that attestation.
Thanks, Humera. I don't know, MacDonald, if you have anything to add from what you've seen happening in the banking world?
Yeah, very similar to what Humera had said. Essentially, it's the firm's prerogative to determine how they want to go about assurance. We've seen institutions leverage their internal audits to sort of provide assurance over the process. We've also seen institutions who have gone externally because, again, they want as much as possible to align more closely with what institutions around them are doing. So again, depending on the nature and the complexity of the business and the direction that management wants to go, it's essentially up to the firm to determine how they want to go about assurance.
Yeah, thank you for that. So it's a real mixed bag, I guess. So I think we're drawing to the end of our time now. We do have a few other questions, but like I say, we'll come back to you with an FAQ document when we send out the slides after. So thanks a lot to all of our fantastic presenters for their insights this morning. We hope you found the session interesting and useful. As I said, we'll be sharing this recording on our website and via email, so stay tuned for that. And of course, if you have any more questions or you need any more information, then please feel free to reach out to any of us. Our contact details will be in the slides. We really appreciate your time and hope you all have a great day.